US stocks rebounded to start the week following the public firing of the government statistician who puts together the jobs data. That move, following news of a weaker than anticipated labour market, sent equity prices tumbling no sooner than they had reached yet another record high. To discuss the latest economic data and markets, I'm joined by Chief Market Strategist here at Interactive Brokers, Steve Sosnick. Welcome to the program, Steve.
Good morning, Andrew. Great to see you.
Likewise, sir. Likewise. Steve, your take on the public firing of the BLS statistics chief by President Trump last week?
I happened to be actually doing a live TV broadcast while the numbers came out, and I was on with an economist and a bond market strategist. We were on actually Yahoo Finance, and the number was stunning. We were all just, I don't know that you could really get the reaction shot of how our jaws dropped, but that revision was startling. And obviously you do have to question, when you essentially wipe out 2 months worth of job growth, what went wrong? But as the dust settled, the explanations have tended to be from the sort that there are household surveys which do unemployment, and there's business surveys which do non-farms payroll. The response rate has been getting worse and worse. Apparently it used to be 85, 90%. Now it's down about 60%. And so the results don't trickle in sometimes for a month or two. And clearly what had happened was people had been hiring, gave in their results on time. People had been firing, held them back. The number was stunning, but there was an explanation for it. So in terms of wanting an explanation, in terms of needing an explanation, absolutely, we should have gotten one. And that would have been crucial had that been communicated immediately. The problem is, I don't like the idea of shooting the messenger. Mm-hmm. I see no reason to believe that the commissioner's actions were at all nefarious. But as I listened to explanations, most recently, the president was speaking on CNBC this morning. A lot of it seemed to be rooted in grievances about how the numbers came out around the prior election. And that puts us down a very slippery slope. I think we need transparent data. I think the idea of sacking someone simply because you don't like the data, even if it does raise eyebrows, even if it does drop jaws, even if it does require a detailed explanation, that sends us down a bad road, because everything out now is going to force people to question whether the data has been cooked somewhat to avoid those in charge of compiling it from getting in political hot water.
Correct.
Very difficult.
Correct me if I'm wrong, Steve, but the BLS also puts together the inflation report.
Indeed, they do. Again, the president was asserting we have no inflation. I'm going to assume that's hyperbole rather than a sincere belief, because the numbers clearly show that zero is not the number. We can argue whether the current number is too high, too low, adequate, by all means, but you do have to wonder now, will those numbers get politicized? And so it's a very slippery slope. It's unfortunately the sort of thing that happens. I'm not going to go down that road, but it's not a good look for the US.
Let's get back to the jobs number though, Steve. For the past several months, I think the economists' estimates have been much lower than the actual outturn. So we've exceeded expectations by a lot. And to me, they have dumbfounded the thought that the economy is hitting any kind of a speed bump, or certainly anticipating the forthcoming tariffs, which are due to come in later this week. So are we just about where we should be if we'd have really hit the numbers that economists were forecasting in February, March, April, May, and June?
Here's the crazy part. I've always decried ADP as being a lousy indicator of the number that follows. Typically ADP comes out on Wednesday and the government comes out on Friday. And those numbers don't really jibe usually. Here's the crazy part. Someone posted, I forgot where, I'd point you out if I remember. And it is that the ADP report basically has shown a very flat level of labor over the past, call it 6 months. When all said and done, that's actually what the BLS survey is showing us.
Right.
So one might argue that the ADP number on a longer term basis is actually more accurate than the BLS number. This is where I wish we had Jose to turn to today. I know he had a conflict and couldn't do that, but that's an interesting problem. Yeah, the state of the labor economy, believe me, I'm sure Chairman Powell would have loved to have had these numbers on Wednesday when he was basically saying, and something I agreed with as well, which is we're not in restrictive policy. Monetary policy is not preventing us from doing anything that wants to get done in terms of credit, in terms of speculation, in terms of all that other stuff. Less than 48 hours later, the data changed. And the data said the labor economy is really not nearly as healthy as everybody thought it was. Would he like to have that back? Might that have changed the Fed's discussion? I'm going to guess probably. We still don't really know the inflationary outcome that's really going to arrive from the tariffs. They're still pretty much a work in progress. They're really, for the most part, just getting implemented tomorrow, like I think tomorrow or the day after.
And some might say actually on the fly.
Yeah. And then that also means that considering you're talking about government systems, how long does it take for those systems to adapt and get the right numbers in them? So it's still very much a work in progress. And there's still some real uncertainty. One of the things that people were hoping for was that the uncertainty would be behind us. But if you still don't know what the outcome is going to be with China and Canada, our two biggest trading partners, two of our three biggest trading partners, it's hard to say that there's a lot of clarity still built in. This is all what's been reflected in the markets recently.
So notwithstanding that we still don't know with any clear outcome, I think it's safe to say, as you said, there's a potential slippery slope ahead of us in terms of future data, who's controlling the data, a stronger likelihood than a weaker likelihood of lower interest rates and sooner. Are you more surprised that the dollar hasn't weakened in response to what happened on Friday, or that longer yields haven't risen?
The dollar actually, I think, got a bit oversold. I am surprised still that we're not seeing a steeper yield curve. The action at the short end of the curve is what you would expect if you were drastically rejiggering your rate cut expectations.
True.
And also, one of the more perplexing things to me was that the bond market was either stagnant or seeing rising yields at the same time that the dollar was weakening. That's a sign that people are selling bonds. What we saw on Friday was the dollar weakening as bond yields plummeted. That fits. So the problem is there's all these different moving parts. I think what's more perplexing yesterday was that bonds didn't really change their point of view. Currencies didn't change their point of view. Commodities didn't really change their point of view. And stocks just decided Friday didn't happen. That to me is the far more perplexing part of it. And it just shows the willingness of traders to buy dips, chase rallies. But I think that to me was the much more perplexing response because basically what the bond market and basically what all these other asset markets decided on Friday pretty much held yesterday and seems to be holding pretty much today. We're not seeing big moves in bonds and dollar, but going forward, I do have to wonder about the steepness of the yield curve because I do think we're introducing some combination of higher deficits and or higher inflation, both of which can be punishing to the long end of the curve. And particularly if you're going to get a Fed that is going to err toward the side of cutting rates rather than keeping them stable, that pushes down the short end of the curve while also potentially raising the long end of the curve. So that to me is the tell that we really have to watch going forward.
So path of least resistance for now would be up for stocks. What are the weaker parts of the stock market that currently give you pause for thought? Are you seeing any signs of weakness or kind of red flags going up?
The biggest red flag is that we really have very much of a bifurcated market. I'm not going to make a case here against the mega cap tech stocks. Very hard to do, at least after seeing some of the numbers, after seeing Meta's numbers, Microsoft's numbers, and Alphabet's numbers. These Palantir yesterday, these companies are delivering. The problem is it's the concentration. And what gets me here is we've been in a bifurcated market all along, let's say growth versus value, or the idea that I want to be watching here consumer discretionary stocks. I want to be watching travel stocks, these kind of things, because there's a lot of anecdotal evidence piling up that consumers are cutting back. Consumers are 2/3 of the economy. And so even if the AI spending proves to be fruitful, because the companies that are spending on AI just are accelerating that spending. Obviously, they think it's money well spent. And so far it has been in terms of stock market returns. Ultimately, you need a decent economy. And I think that's one of the things the stock market loses sight of, because one of the rationales given for why the market rallied yesterday was the idea that rate cuts might be coming faster and deeper than had been priced in. Yeah, I always have to say, you have to ask the why. If you're getting rate cuts because because inflation is benign and the economy is steady state, and you say, okay, we got room to cut 25 or 50 basis points here and there because those circumstances line up, by all means do, and that's a good cut. If you have to do it because the economy is weakening, a lot of times the Fed is behind the curve on that. And so there's a lot of careful what you wish for type of thinking in that. Again, that's why I look to the disjointed nature of stock and bond returns yesterday as thinking about that in a different state of mind.
As ever, Steve Sosnick, thank you very much for joining me today.
Thanks, Andrew. Take care. Bye-bye.
All right. And to the audience, if you enjoyed today's podcast, don't forget to subscribe wherever you get your podcasts from. Bye for now.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.